Hello everyone and welcome back to this segment of Retirement Essentials. In today's short video, I want to share with you a Facebook Live that I created recently that talks about a penny saved and a penny earned. This is a simple video that talks about a misconceived truth or myth that retired or tax-deferred savings is the best way to save for retirement. That's the myth that I want to quickly unpack for you today and flip that on its head and say that's not actually true. It's tax-free interest plus tax savings is the best way to save for retirement. So I'm so grateful that you decided to join me inside of this video, and without further ado, here we go. Hello Facebook, and welcome back to another off episode of Brighter Retirement Radio. We're in office today, and I would like to speak to a specific investment myth that a lot of us get caught up in, and that which is this idea that interest earned inside of your portfolio is the most important aspect of growing your retirement. So what I wanted to really do is address this concept in the light of a common phrase that's been used for hundreds of years, which is a penny saved is a penny earned. And I bring this up because within Brighter Wealth Academy, we really teach this idea of the penny saved effect. Typically, we think of the term a penny saved is a penny earned, is this idea that it's very important to make sure that we save all of the pennies because it really adds up over time. It builds your savings over time. However, inside of retirement finances, what I've seen as I've talked to lots of students and clients over the years is that the common concern or common focus is usually just your retirement accounts and your savings accounts. How many saving dollars have I accumulated yet? Or what interest am I earning on my investment accounts? And how those are growing over time. However, what I really want to mention here is it's not just about how much you can grow your current dollars that's earning you this penny saved effect. It's actually that in addition to the dollars that you can save. And for many of those of you that follow me on Facebook and within our academy and our podcast, you know that I am a big supporter of tax savings within retirement finances. And so in today's Facebook Live, I kind of want to use a couple of slides to walk us through this concept of a penny saved is a penny earned. And so this idea that, and it's almost a myth, I'm going to just put myself out there and call this a myth. It's a myth that tax-deferred interest provides the most growth for your retirements. Now, today I'm specifically going to be talking about tax-deferred accounts, not necessarily brokerage accounts that are taxable at the time of growth, but tax-deferred accounts. So tax-deferred interest provides the most growth for our retirement savings. The reality of it is that's actually a myth, and I'm going to walk you through why I actually think that is the case. So the truth of it is that really a penny saved is a penny earned, meaning that with your tax savings, consistently reducing your income taxes each year can add up to a significant amount, and these savings will compound in your tax deferred accounts to maximize the penny saved effect. So let me kind of walk that through with you as we talk about what that really means. So many of us, as we're focusing on our returns inside of our tax deferred accounts, underneath our retirement finances is we're paying out specific taxes. So we have pension income, Social Security income, and you're taking your required minimum distributions from your accounts. So all of those dollars are filtering down into your retirement finance, and depending on those sources, it determines how much in taxes you're paying on those income sources as they go out. And it's the outflow of those tax dollars that is what we're focusing on here. So if you have $1,000 of interest earned inside of your investment accounts, does that compare to if you were able to save $1,000 in taxes? Well, a dollar is a dollar, right? An after-tax dollar is an after-tax dollar. And so if you can do both, that genuinely is the best of both worlds. And when you combine interest earnings and tax savings, both of those together can be a powerful tool for you as a retiree to make sure that you're doing your best you can to not outlive your money or not run out of money before you pass away. And so let's continue on. I'd love to share a couple of examples of what this looks like. Inside of this penny saved effect, inside of Brighter Wealth Academy, we have a strategy called Brighter Giving, and a tax story as tools that help us really come to the conclusions on what is the best way to maximize the penny saved effect. So here's one specific example by Linnell and Ellen. They actually said, last year we used a QCD tax strategy, which is one of the tax strategies inside of our Brighter Wealth Academy framework, to make our charitable contributions and saved $4,050 in income taxes. And they continued to say, if we would have done the same the previous year while on a service mission for our church overseas, we would have saved $7,606 in taxes. Lesson learned. And so the reason why this is so powerful is that, and I'll share this slide so you can see, the reason why this was so powerful for Linnell and Ellen are these dollars were dollars that they're using inside of their retirement finances towards a charitable experience. In their case, it was a mission fund. When they were overseas, they were paying a lot more per month towards this charity. And in a normal tax year, they were just paying a tithe to their church. And so those are significant savings amounts on top of their investment earnings. So both their investment earnings together with their tax savings really maximize this penny saved effect. Here's another example of Gerald and Judy. And they said, we had an appreciated rental property that we sold and put the proceeds into a donor advised fund. This saved us over $30,000 of capital gains taxes, and now we have a fund to pay our tithing, fund our grandkids' missions, and other charitable contributions for the years to come. So this is another example of effectively using this and maximizing this penny saved effect to save on taxes underneath. Obviously, both of these families are doing a phenomenal job of growing their retirement assets through interest earned in investment vehicles, be it stocks, bonds, mutual funds, or real estate, or fixed index annuities. They're doing a good job of growing their assets that way, but what they're doing as well is improving or lessening the outflow of taxes. So both interest earnings and tax savings together is really what's maximizing their retirement assets over time. So let's go back here and to really wrap up this myth and turn it into a truth. So we can say that the myth or the misconception is that tax-deferred interest provides the most growth for our retirement. But really the truth, the total truth here is tax-free interest plus tax savings provides the most growth of our retirement savings in a rising tax environment. So a part of that truth that we won't talk about in this Facebook Live is converting from tax-deferred to tax-free, so an IRA to a Roth IRA. But this additional tax savings portion is extremely, extremely valuable as you do that. So the question for you, for all of us then would be, within the academy, within your retirement finances, what are some effective tools to do that? Because that all sounds phenomenal, Devin. It sounds like if we can move from our tax deferred accounts to our tax free, and if we can maximize our interest and then maximize our retirement tax savings, that's phenomenal. What's the next step? How do we actually do that? Well, inside of our Brighter Wealth Academy, we've actually created a digital course called the Retirement Taxation Masterclass. I appreciate you guys joining me inside of this Facebook Live, and I hope to see you within the Retirement Taxation Masterclass. And for all of our Brighter Retirement Radio listeners, we appreciate you subscribing to the podcast and leaving a review. We absolutely appreciate those reviews, and that's how we reach more people, is ranking better on iTunes. So we appreciate all of you, and we will see you next time.